Back to the coronavirus is yet to be determined, but one industry may be prepared to weather the storm, and that would be the insurance business. For more on the risks, we're joined right now by Eric Dinallo. He's Executive Vice President and Chief Legal Counsel at the Guardian Life Insurance Company of America. Also, of course, the former Superintendent of Insurance for New York State. And Eric, it's great to see you. Thanks for joining us.
Thank you. Thank you. And also, I've recently rejoined the law firm of Debevoise and Plimpton.
Of course.
Good to see you.
Right. Good to see you, too. Eric, let's talk a little bit about how the insurance industry is prepared on two fronts. First of all, what kind of liability do they have for any of these canceled events, other issues that are taking place? And then how are they prepared with their own investments? Because when you see these huge moves in the Treasury markets, obviously that concerns us about pension funds, insurance companies, and others. So let's start with the risk at this point. What's the situation look like?
So I just think compared to 10 years ago, insurance companies are in a fundamentally better place. They're much more diversified. They're much more liquid. They have the highest order of risk management in place, and I think that their capital standards are even higher than they were 10 years ago. The regulators have insisted upon what's often called redundant reserving or excess reserves. So I think fundamentally, as an ability to make good on their liabilities, the insurance industry is in a very good place. These conditions are the exact conditions that they stress test for, they reserve to, and they work with the regulators on being able to make good on their obligations. But I would say that you could see insurers start to get more and more into fee-based businesses, get into more short-dated obligations. I would think that they're going to consistently think about getting rid of sort of core, non-core businesses for them in order to really focus on having as much capital for their obligations. On the asset side, so to speak, they have, in fact, I think, been increasing the quality of their assets. But I think in order to get a little more yield, you're going to see trends towards more real estate, CLOs, CFOs. I could see them partnering more with private equity to improve some of their capital positions. This is also a good time, in fact, for them to go to a market on debt offerings because they're very highly rated and they can bring in, $500 up to $1 billion and promise a fairly low interest rate on a horizon of 50, 60, 70-year repayment. Also, this is a time they are buy and hold companies, so I could see them going deep into the market and looking at compressed or challenged quality of assets and just loading them on. That's been a consistent theme in the last several years for insurance companies. So I'm actually very optimistic about their positions. There will be, as you say, there will be pressure, which we can talk about, from the inevitable claims around the virus, from the potential for business interruption on the property and casualty side. But I feel like the industry is well capitalized and prepared for that.
I guess my question would be, if they've already gotten a little riskier by trying to get more yield by going maybe more into stocks or something, if you're trying to get more liquid right now to potentially pay claims, it's a lousy time to try and be selling when you're already down 20%. Yeah,
but my point is that if you look at what they're permitted to invest in, like 90% of the pie is extremely conservative, high-grade debt, bonds, et cetera. The regulators require the premiums to be in those kinds of instruments. I'm talking about getting like a marginally better yield, but really a huge number of the book. And it's also done under what's called statutory accounting. We've talked about this before, as opposed to GAAP accounting, which tends to be very heavily capitalized and very good about riding out short-term volatility against a long-dated match of liabilities and assets.
One thing that Mohamed El-Erian talked about with us earlier this morning is just how you are seeing markets that had been incredibly liquid, places that you wouldn't have seen liquidity in the past, but we've poured so much liquidity into the market, and now some of those places are actually drying up. Is that a concern for any of these things? Should I not worry about insurance companies there? Or, I mean, what you've said so far sounds very reassuring.
I'm not worried because I think they've already put themselves in a very liquid position. The other thing to take into account is while interest rates have dropped, quite a bit recently, there's been a downward trend now for a long time, and insurance companies have seen that. They've reacted to it. They are poised for a long time of lower interest rates. It's not as if it just fell off the table overnight from their perspective.
True. Eric, anything else you're noticing right now? Anything that concerns you just about the markets that we're watching, let's say, over the last 2 weeks?
Well, I think there's going to be some, debate, so to speak, among the regulators and the companies on a variety of things. You can already see the regulators reacting, sending out inquiries. New York State Department of Financial Services has something on its website now asking the companies about their business continuity and readiness. Although I think from having been inside of 3 companies so far, they are absolutely well placed for business continuity and being able to work remotely, et cetera. I think that the regulatory oversight has been helpful in that, again, the companies are very, very well capitalized. I do think that there'll be inevitable fear, which I just heard on the previous segment, about morbidity and mortality claims at the companies. But I want to emphasize that along with the capitalization that I think they've done really well on, they are also excellent risk managers. So they have factored in and stress tested for pandemic and epidemic for over 100 years since the Spanish flu. And I think that while people are appropriately very scared, they should be reassured that the industry is well placed both on the life insurance and the property and casualty side for these extreme events. That's why we have insurance. That's why people buy insurance. And that's what the industry is there for.